Okay, let's dive in. Welcome to the Deep Dive, the place where we try to make sense of the world's most complex and, frankly, sometimes intimidating topics.
And distill them down into what you actually need to know.
Exactly. And today, we're strapping in for a big one. We're talking about what might be the most transformative and definitely the most controversial investment period of our lifetimes.
The $37 trillion AI supercycle.
Right. And if you're out there feeling like you're getting whiplash from the news cycle, one week it's a bubble, it's about to pop. The next week it's literally the future of humanity.
You are not alone. It's confusing for everyone.
It is. So our mission today is to just cut through all that noise, all that volatility, and really try to establish the long-term thesis that can anchor your perspective.
And we're doing that by focusing on a pretty specific source, an expert whose track record really demands some attention. We're leaning heavily on analysis from Chris Camillo, and his ability to call these huge macro-level market moves. It's honestly remarkable. This isn't just some pundit on TV. This is someone who has been demonstrably ahead of the curve time and time again.
Absolutely. I mean, just think about the calls we have from the source material. He called the best time to buy the S&P 500.
Which is up, what, 35% since then?
North of 35%. He called the sweet spot for Robinhood, which then shot up over 200%. He was right on the money with the big run-up in energy stocks.
100, 200% gains there.
And most importantly for our conversation today, he's been totally spot on about this accelerating rise of AI and robotics over the past year.
Yeah, that kind of pattern recognition, I mean, across totally different sectors.
Yeah.
It tells you something. It tells you that you need to lean in and really listen to the methodology.
So our deep dive today, it's really built around three core pillars. First, we have to get our heads around the fundamental thesis. Why is this an AI supercycle and not just another tech boom?
Right. And second, how do you build the kind of conviction you need to actually survive the downturns?
Yeah.
Because they are going to happen.
Oh, they're inevitable. And then finally, we'll get into the specifics. The high conviction areas that our source expert believes are positioned for really generational growth.
The companies where he's actually putting his own money right now.
Exactly. So let's start at the very top. Let's start with the scale of this thing. Because if you don't grasp the sheer magnitude of it, you're just going to mistake the short-term noise for the long-term signal every single time.
We have to start there. I mean, you have to take that 30,000-foot view, because if you don't, the day-to-day stuff, the volatility, it's just going to completely distract you from what's really happening. In the view of our expert, this AI revolution, it's not just the next big thing in tech. He says it's, and I'm quoting here, the biggest thing that we will likely ever see in our life, period.
That is a huge statement. I mean, you think about the Industrial Revolution, the internet, mobile phones.
It sounds like hyperbole.
It does, but the reasoning behind it is what's so compelling. He's arguing that over the next, say, 20 to 40 years, AI is going to make every industry.
Every single one.
From manufacturing to healthcare to, government services. It's going to make them all meaningfully more productive.
Yeah.
And way more efficient.
And when you start to project that level of productivity gain across the entire global economy, the long-term implication is, well, it's profound.
Right.
The philosophical belief that's really fueling this whole supercycle is that this tech acceleration could actually help humanity climb out of the cycles of scarcity that have defined our economic lives for forever.
Wow. So we're not just talking about better stock returns. We're talking about a fundamental shift in how society operates.
A shift in the availability of goods, services, energy, everything.
Okay. To put that into a frame that maybe we can all relate to, he uses the analogy of the first iPhone.
The iPhone 1.
Right. When that thing came out in 2007, you could find a million reasons to be skeptical. The connection was slow, the battery was terrible, it was expensive, there were barely any apps.
You could have easily shorted the stock based on those details and felt very smart for about a week.
Exactly. But if you actually held that device in your hand, if you looked past those initial flaws, you saw what it represented.
You saw the potential.
A technology that was so transformative, giving every single person a supercomputer in their pocket connected to all the world's information. You just knew it was going to completely restructure the way that we live our lives.
It was a change in kind, not just in degree, a fundamental shift.
And that's the argument for AI for us today. It's so fundamentally changing the economics of computation and information that the little daily hiccups, the stock dips, the quarterly earnings misses, the arguments about regulation, they start to feel trivial.
Yeah, it's like we're arguing about the scratches on the paint job of a spaceship. when the real story is that we've invented an engine that can take us to other planets.
But those hiccups are real, and they create what our expert calls this recurring boom-bust sentiment cycle.
And this cycle isn't driven by the technology failing. It's driven by investors who just aren't willing to go deep, to do the actual homework to gain real conviction.
They're trading on headlines, not on the underlying physics of it all.
Exactly. And we just saw a perfect case study of this with the whole DeepSeek story.
Oh, that was incredible. The market absolutely freaked out.
People were convinced that DeepSeek was going to, quote, completely bust up the entire AI economics model.
Because the fear was that this cheaper open source model would just destroy the profit margins for the big players like OpenAI and Google.
And the market reacted, instantly. It lost something like $1 trillion in value across the sector overnight, based on this one fear.
Which turned out to be completely wrong.
Completely. Because the key detail that all the fear-driven traders missed was the difference between a training model and a reasoning model.
Okay, break that down.
So training is when you feed the AI tons and tons of data to build its knowledge base. That's the initial step. But DeepSeek was a reasoning model, which is designed to take that knowledge and actually do stuff for you. Analyze a legal contract, write some code, that kind of thing.
It's the application layer, the part you actually use.
Exactly. And here's the kicker. When investors finally went deep and looked at how these reasoning models work, they realized that while the cost to train the model might be going down, the cost to actually use it, what's called the inference cost, was skyrocketing.
So what is inference exactly, just for everyone listening?
Inference is basically the thinking part. It's the process where the trained model uses its intelligence to come up with a response to your prompt.
Got it.
And people realize that these new advanced reasoning models require 100 times, maybe even 1,000 times, more inference, more compute power than the simpler models.
So wait, even if the training cost goes to zero, the cost of actually getting a result from the AI is still massive.
Astronomically high. The economic model didn't fall apart at all. The profitability wasn't destroyed. The cost just moved from the front end, the training, to the back end, the application.
And the total amount of compute power needed to run the world on AI is way, way bigger than anyone thought.
Exactly. The market just misunderstood the physics of it, had a massive panic attack, and created a huge buying opportunity for anyone who'd done their homework.
And that kind of misunderstanding leads us right into the fears we hear all the time now, especially the Michael Burry thesis.
Right.
The guy from The Big Short.
He's arguing that AI infrastructure companies are over-leveraged and they're just overbuilding everything, a classic bubble.
And his specific critique, which is pretty clever, focuses on how they value the hardware, the chips.
Right.
He's saying, look, these companies are booking these super expensive chips on their balance sheets as if they're going to be valuable for 5 or 6 years. But the pace of innovation is so fast, those chips might be obsolete in 2 or 3 years. So if the chips only last half as long as the accounting says, the whole financial model breaks down. The projected returns collapse.
It sounds a lot like the mortgage crisis, doesn't it? The underlying assets, the subprime loans back then, the chips now, aren't worth what the books say they are.
It's a very compelling argument if you're just looking at it through an accountant's eyes.
It is. But our expert's counter-argument is really forceful.
Yeah.
It's rooted in that long-term conviction. He basically says, even if Burry is 100% correct about that one specific microcycle,
Even if they overpaid for this generation of chips.
it fundamentally does not matter in the grand scheme of things.
Why not? I mean, that sounds like a huge financial risk. Why is it irrelevant?
Because that whole debate about chip depreciation is just one little mini cycle in the AI story, the speed bump. It's nothing compared to the much more important larger story, which is that we are inventing generalized intelligence. The value created by AGI, by true machine intelligence that solves huge human problems.
Yeah.
It's almost priceless. So if we achieve that goal, who cares if we had to buy 5 generations of hardware instead of 3 to get there? It's a rounding error.
So it's an investment in the outcome, not in the individual tools along the way.
Yeah.
Your conviction is in the 40-year story of global productivity, not in this quarter's amortization schedule.
Exactly. You look at that dip, and if you have conviction, you see a sale. You don't see a systemic failure. It's just noise.
And that conviction is everything, because the psychology of this market right now is it's just
It's
bizarre.
completely wild. Our expert pointed out this huge paradox recently. The market, the big indices, they hit an all-time high. But at the exact same time, the fear and greed index hit extreme fear
Yeah.
for the first time ever at an all-time high.
That makes no sense. How can you have record highs and extreme fear at the same time? It's like everyone's buying, but they're terrified while they're doing it.
It signals this deep, deep pessimism, or maybe disbelief, right alongside these sky-high valuations. It's like people feel they have to be in the market, but they don't believe in it, and they're just waiting for the other shoe to drop.
And that conflict just reinforces why you need that long-term, multi-year mindset.
Totally. Our expert is super clear on this. Nobody, not him, not the smartest person on Wall Street, can predict what the market will do in the next week or the next month. It's impossible.
So your focus has to be on the years, not the weeks.
Exactly. When he was telling people to get a second job and pile into risk assets, the time frame he gave was the next few years, not the next few weeks. That deep, long-term conviction is the only thing that can protect you from the volatility.
Okay, but this is where we have to address something that looks like a huge contradiction.
The options trading.
Yeah. The same expert who preaches this long-term conservative conviction also posts screenshots of his account with these massive leveraged bets. I mean, weekly call options on Nvidia.
And he's admitted he'll sometimes put 10, even 15% of his entire liquid net worth into one of these aggressive short-term trades.
Which just looks like pure gambling. It feels like the total opposite of a long-term view. We have to square that circle.
We do, because when the average person listening hears weekly options and 15% of my net worth, they're thinking lottery ticket.
And for most people, leveraging like that on a weekly bet is just, it's a recipe for disaster. So how does he separate that from pure speculation?
It's a really crucial distinction he makes. He explains these aren't just random guesses. They are tactical bets based on a deeply researched thesis about a very specific information window.
An information window? What does that even mean? Because that sounds like something the average person just doesn't have access to.
It is. The example he gave was around anticipating specific news about data center deals.
Okay.
He might have information about who's flying to these high-level meetings in, say, the UAE, where they're talking about building huge data centers and launching sovereign AI initiatives.
Let's define sovereign AI quickly. That's a newer term.
Right. It's basically when a country decides it needs to build its own AI stack from the ground up. Its own models, its own infrastructure, for national security reasons. They don't want to rely on the US or China.
So it's a national security spending story.
It is. So his bet isn't just a random guess that Nvidia will go up. It's a bet on the timing of that specific news hitting the market and causing a short-term pop.
I see. So he's betting on a known upcoming catalyst inside a very short, defined window.
Exactly. And that's the part the average person cannot replicate. You and I don't have that kind of informational edge.
So the takeaway for us isn't to go out and buy weekly options.
No. The takeaway is the importance of conviction based on deep research, not leverage based on secret information.
That makes sense. And it brings us back to the core concept that guides all of this, which is asymmetrical risk.
This is probably the single most important idea in this entire deep dive. Asymmetrical risk just means your potential downside, how much you can lose, is tiny compared to your potential upside, how much you can gain.
And with AI, the argument is that the downside is, what, a 30% or 50% market correction?
Right, which is painful but limited, but the upside of actually inventing intelligence and unlocking a $37 trillion supercycle is 100x, 200x more. The upside is almost unlimited.
So the real fear isn't losing some money in a dip.
No. The real fear is the opportunity cost of completely missing out on this generational wealth creation event.
He calls that an unacceptable asymmetric risk.
Yeah. And he believes that big institutional investors, pension funds, they're all going to eventually realize they have to participate. They can't justify having zero exposure to their clients.
And that necessity is what will keep forcing money back into the sector, even after big dips. The pressure's fundamentally upward.
Exactly.
So let's bring Michael Burry back into this for a second, because it's a good way to test this conviction. Our expert thinks Burry might be in over his skis on AI. What's the fundamental difference between the flaw Burry found in the mortgage market and the supposed flaw he sees in AI infrastructure?
It's about scope and the possibility of a solution. The mortgage crisis, as our expert says, was insular. It was a specific, contained problem.
A bunch of bad loans were packaged up and sold. Once you found the bad loans, the whole thing was guaranteed to sink.
Right. It was a hole in the boat. There was no theoretical way out. It was a zero-sum game of disaster. The AI supercycle, on the other hand, involves the entire world innovating at the same time, trying to create something fundamentally good intelligence.
It's not a fixed flaw in an asset. It's a massive, ongoing investment in a new kind of production.
It's global, it's expansive, and it's just too big and too foundational to just implode like that. Innovation creates new value, and the whole world is innovating at full speed.
It reminds me of that old story about Isaac Newton and the South Sea bubble.
Oh, yeah.
Made a fortune, sold early, watched his friends get richer, got FOMO, jumped back in at the top, and then lost everything in the crash.
He said he could calculate the motions of the heavenly bodies, but not the madness of people.
And that madness is amplified 1,000 times today with social media and constant updates. The lesson is, when you see an iPhone moment, you don't sweat the daily details. The big story is total transformation.
And every dip is just a chance to add to your position.
Okay, one last fear to tackle. This idea of circular financing.
Right. The fear that a company like Nvidia is just lending its customers the money to buy its own chips.
Creating this closed loop that looks great until the customers fail and can't pay Nvidia back.
It's a legitimate short-term risk. It's absolutely a form of leverage. If the customers can't monetize those chips, Nvidia takes a big hit.
So why isn't our expert worried?
Because he sees it as a strategic move by a company with extreme conviction. Jensen Huang and Nvidia aren't just hoarding cash. They're using their massive balance sheet to actively accelerate the AI revolution.
They're betting on the ecosystem.
They're betting that the long-term monetization is a certainty. He says it's only a huge problem if there's no monetization that eventually comes in over the next 5 to, call it, 10 years.
And given that AI is going into every company on Earth, he's willing to take that bet.
Yeah. He sees it as Nvidia using its balance sheet as a weapon to build the future faster. It's investing to define the next decade, not just to boost next quarter's earnings.
Okay, so let's move from the philosophy to the actual playbook. For you listening, if you want to align your capital with this big 20 or 40-year thesis, where does our expert have his highest conviction money?
He's focused on 4 core holdings right now. There's Amazon, Bloom Energy, Nvidia, which is sort of the foundational piece you have to own. And then his number one position, which might surprise some people, is Robinhood.
Let's start with Amazon. It feels so obvious, it's already one of the biggest companies in the world. What's the unique AI angle here that makes it so compelling?
The thesis is actually beautifully simple, but the competitive moat is just profound. It's all about infrastructure and robotics. Think about what Amazon has been doing for 20 years. They've been building this obscene amount of infrastructure all over the globe. Warehouses, delivery networks, sorting centers.
The physical plumbing of e-commerce.
Exactly. And the reason the retail side of that business has always been such a low-margin slog, despite the huge revenue, is because it requires hundreds of thousands of very expensive human workers to physically move stuff around.
So they spent 2 decades building this incredibly expensive foundation during an era of costly human labor.
Yes. And now, embodied AI is coming. Physical robots with advanced intelligence that can navigate, grasp things, make complex decisions.
And when that happens, the high cost of human labor just evaporates.
It vanishes. And Amazon is the only company on the planet that's structurally positioned to leverage that technology at a global scale, basically overnight.
So the moment that switch gets flipped, Amazon becomes the biggest winner?
Because they suddenly have an infinite labor machine. A workforce that operates 204/7, makes no errors, and doesn't ask for a raise. Their ability to optimize logistics becomes unstoppable.
And no competitor can catch up because they can't replicate 20 years of infrastructure building in a year or two.
No way. As our expert puts it, long-term, Amazon will be unstoppable. They're about to solve the labor problem for the physical world in the same way AWS solved the compute problem for the digital world.
That is a very powerful thesis. Okay, let's switch gears to something much less obvious. Bloom Energy. This is a power generation company.
Right, and this is where you have to get into the technical weeds a little bit, into the physics of the AI build-out.
We all know data centers use a crazy amount of power.
The crazy amount. But the type of power they need is changing because of Nvidia's new chip designs.
We're moving away from the old 48-volt standard to a much more efficient 800-volt direct current or DC platform.
This is a huge technical shift. The power grid delivers alternating current, AC. But all our computers and chips run on direct current, DC.
So in a traditional data center, you're constantly converting AC from the grid into DC for the servers.
And every single one of those conversions wastes a ton of energy as heat. In these massive new data centers, That waste is incredibly expensive.
So an 800-volt DC platform cuts out a bunch of those wasteful conversion steps, and this is where Bloom comes in.
This is exactly where Bloom comes in. They provide fuel cells that generate DC power directly on site. Their platform is perfectly suited to feed this new 800-volt Nvidia architecture without any of those inefficient conversion steps.
So they can provide the exact kind of power these new data centers need more efficiently.
Right. But here's the most important part. The key factor here isn't just the cost of the energy. It's time to compute.
What do you mean by that?
These data center operators know that the amount of money they can make by selling access to their AI chips in the next 6 months is so insane that they will pay almost anything to get their data center up and running faster. Speed is everything.
So if Bloom can deliver the power they need right now to get these facilities online quickly, the actual cost per kilowatt hour is a secondary concern.
It's totally secondary. They're investing in speed, not just cheap energy. Time is literally the most valuable commodity in the entire AI race. And Bloom is sitting right at the intersection of power scarcity and the critical need for speed.
That's a fascinating insight. Okay, now for the number one holding, Robinhood. This one feels like the odd one out. It's a retail trading app. It's not infrastructure. It's not power. Why is this becoming his biggest position?
The thesis for Robinhood is much more sociological. It's about two massive generational trends and one very aggressive CEO.
Okay, trend number one.
The $100 trillion wealth transfer.
Right. The largest transfer of wealth in human history as the baby boomers pass on their estates over the next few decades.
And our expert is convinced that a huge chunk of that money is going to flow directly onto the Robinhood platform because Robinhood has successfully captured the mind share and the user base of the younger generation. They've built the financial dashboard for the next generation of investors.
Okay, that makes sense. What's the second piece?
It's the CEO, Vlad Tenev. He argues that Tenev runs the company like a startup, not a stodgy old bank.
He takes big risks.
He takes big risks. He asks for forgiveness, not permission. He's willing to break things, push through regulatory hurdles, a bit like an Elon Musk type. And that agility gives them a huge advantage over the slow legacy players like Schwab or Fidelity.
And we've seen how that aggressive strategy can work. Our expert, who calls himself old school, even admitted he was finally drawn onto the platform.
By the 2.5% crypto match, which is a genius long game play.
How so?
It's an incentive that's so good it encourages people to move really meaningful amounts of money onto the platform to get that match. And once the money is there, you're integrated into their ecosystem. You're locked in. It's a brilliant customer acquisition strategy.
And that ecosystem has features the old guys don't, like prediction markets?
Exactly. This is a huge, underrated part of their business. They make it incredibly easy for millions of people to speculate on everything from sports to elections, all within the same app they use for their stocks.
You don't need a separate gambling app.
No. And that convenience is king. It keeps capital on the platform, which reinforces that whole $100 trillion wealth transfer thesis. The entire platform is just built for the psychology of the modern user.
Okay, let's zoom out a bit and talk about the bigger societal impact. Because one of the biggest fears you hear everywhere about AI is jobs. The idea that it's not going to create new jobs, it's just going to concentrate wealth and work in the hands of a few people.
Mass unemployment, the dystopian future.
Right. But our expert has a very contrarian, very optimistic take on this.
He's deeply convinced that long-term AI and robotics are going to be massively positive for jobs, that they'll lead to better opportunities and a better quality of life for almost everyone.
How does that work? What's the logic there?
It's this idea of more things equals more work.
Okay.
We're heading into a world where productivity is so cheap and so easy that we're going to generate an exponentially higher volume of, well, everything. Physical goods, digital content, services.
So if AI can design 1,000 new products in a day, and robots can build them for almost nothing,
then the demand for humans to do the stuff robots can't, customization, sales, maintenance, complex human interaction, it just explodes.
So a world with more things requires more work from humans to manage and service all those things.
Exactly. The jobs will look totally different, but there will be more of them, and they'll probably be better because scarcity is being reduced across the board.
But he does admit there's going to be a rough patch in the short term.
Oh, absolutely. He acknowledges there will be serious hiccups and major job disruption over the next decade. That's unavoidable.
So what's the solution?
He argues that the catastrophic pain of that disruption, a scenario where 50 million people are out of work, is the exact catalyst that will force society to solve the problem.
We only fix huge problems when the pain of doing nothing becomes greater than the pain of taking action.
Precisely. Whether that's through massive retraining programs, new economic incentives, whatever it takes. The pain will force a solution.
So if he's not worried about the jobs apocalypse, what is his actual doomsday scenario? What's the thing that really concerns him?
It's the democratization of violence.
Wow. Okay.
His worry isn't job loss. It's that AI gives cheap, fast, and easy access to tools that can create terrible things. Things that used to require a nation-state's resources.
We're talking about things like designing new biological weapons.
Or sophisticated computer viruses. Or what we're already seeing now, the complete erosion of trust because of hyper-realistic deepfakes.
The danger isn't that AI gets too smart, it's that it makes bad people too powerful too fast.
Exactly. He pointed to that incident where Bill Ackman, a very sophisticated investor, got fooled by a deepfake of Elon Musk promoting some scam. If someone like that can be so easily misled, what hope does the average person have?
Yeah.
That's the real immediate danger to social stability, much more than job loss.
Which brings us to the whole geopolitical situation, which is actually, in a strange way, a kind of backstop for this whole investment thesis.
The U.S. versus China race.
Right. The race for AI supremacy.
This is maybe the single biggest non-market factor that should give you confidence in the sector. This race ensures that the U.S. government is going to support and, if needed, backstop our AI ambitions.
Because they simply cannot afford to let China get there first.
No way. Achieving AGI, or superintelligence first, is an existential national security issue. It gives you a massive advantage in warfare, in economic production, in developing vaccines, everything.
It's not just a tech race, it's the new arms race.
It is. And the implication for you as an investor is that the underlying infrastructure of AI in the U.S. is basically too big to fail as a sector.
Individual companies can go bust, for sure.
Of course. But the foundational technology stack itself will be supported and protected by the government. That adds a huge layer of long-term confidence.
And speaking of government, he also spent some time on the huge, untapped opportunity for AI to be used within government.
Yeah, this is the fascinating idea, because so many of the problems in government on both the left and the right aren't about evil people. They're about massive, entrenched inefficiency and miscommunication.
Just data being stuck in different silos, agencies not talking to each other?
Exactly. And AI could be a massive corrective for that. It could analyze trillions of data points on government spending, on supply chains for big projects to help governments be more productive with our money.
To make our tax dollars actually go further.
Imagine using it to optimize military budgets, or Social Security distribution, or building a new bridge. He mentioned how something as simple as renewing your passport has finally become efficient because of basic tech. It used to be a nightmare. Now it can take 5 minutes online.
So if basic internet tech made government 10 times more efficient over 15 years,
AI could make it 100 times more efficient, way faster.
and that could fundamentally rebuild trust in the system.
And he even had this provocative idea. Could AI act as a political mediator? Could it analyze policy proposals from both sides, show the objective mathematical outcomes, and cut through all the ideological noise?
Like bringing back the old days where politicians could at least agree on a common set of facts before they started arguing.
Exactly. It could restore a level of efficiency and trust that we just haven't had in decades. A massive, massive opportunity.
Okay, before we get into the final takeaways, we have to talk about risk management because a lot of this sounds very aggressive. And the best lessons on risk usually come from failure.
Especially when leverage is involved. Our expert shared this really painful story from his early 20s. He admitted he lost everything.
Ow.
He took cash advances from his credit cards to buy options on one single stock. He was completely over-leveraged.
And the stock.
Turned out to be a total fraud. The SEC froze trading in the stock. And because he was holding short-term options, they just expired worthless while the stock was frozen.
He lost everything.
Every single dollar.
Yeah.
Went into massive debt, hadn't moved back home with his parents. The ultimate lesson in concentration, risk, and leverage.
So what were the big takeaways from that disaster that shape how he invests today?
3 big things. First, you have to make those mistakes when you're young and you're playing with small money, losing thousands of dollars and not millions. It's the cost of your education.
Right.
Second, risk management is everything. Never, ever leverage yourself to the point where one bad bet can wipe you out. And third, and this is maybe the most important, never rely on a tip.
Do your own homework.
You have to do the hard, deep work yourself. That is the only way you earn the kind of high conviction that can justify taking any kind of aggressive position.
So for you listening, how do you take that lesson and structure your own money to play in a cycle like AI without getting wiped out? The answer he gives is bucketing.
You need 3 different buckets for your money. First is your safe bucket. This is cash, boring stuff. It's what lets you pay your bills and sleep at night no matter what the market is doing.
Second is the growth bucket. This is your get-rich-slow money. Index funds, real estate, the bulk of your net worth should probably be here.
And then, and this is critical, you need a get-rich-quick bucket. This is your fun money. This is where the risk assets, the big swings, the AI plays, this is where they live.
And the advice for the average person is so important here. You only put money in that third bucket that you are 100% willing to lose.
Completely. The expert can put 15% of his liquid net worth in a trade because his net worth is already huge. For most of us, that bucket should be much smaller, maybe 1 to 5% of your investable assets. Enough that the upside could be life-changing, but if it goes to zero, it's okay.
And to fuel those buckets, he has this great psychological trick called the 100x mindset.
Yeah, this is a powerful way to think about saving. You have to see every single dollar you save or invest today as being worth 100 times more in the future because of compounding.
So that $3 you spend on coffee every day.
It's not $3, it's really $300 a day in future buying power that you're giving up.
When you frame it like that, it completely changes the decision. It's not about denying yourself a coffee. It's about choosing between $3 today and $300 a day of freedom in the future.
And when you adopt that mindset, you start making all these small sacrifices that add up to a massive amount over time. It just builds that discipline.
Now, moving beyond personal wealth, his long-term goal isn't just a bigger bank account. It's building a $1 billion foundation, which says a lot about his philosophy on ultra-wealth.
He's very critical of traditional trust funds. He thinks they often just create lazy, unmotivated kids. He loves the foundation model for a few reasons. 1, the money grows tax-free, so it compounds faster.
2, you're legally required to give 5% to charities every year.
So the wealth immediately starts having a positive impact. And third, and this is the key, the kids get involved as administrators.
It gives them a purpose, a mission.
A mission, exactly. It's way better than just handing them a pile of cash. And it also provides a safety net. They can draw a small salary and get health insurance from the foundation so they're secure, but without all the psychological baggage of being ultra-rich.
And he's so committed to this goal that he admitted he got a $20,000 penalty right after setting up the foundation because he immediately started trading options and using margin with the money.
Which is illegal for a nonprofit. He learned that rule the hard way because he's just so driven to maximize those returns to hit that billion-dollar goal.
But all of this experience has led him to this final point about wealth, which is that there's a sweet spot.
Yeah, he says having too much money is equally uncomfortable as having too little.
Really? How so?
He says the biggest high, the absolute peak of happiness from money is just achieving financial independence. Being able to go to all your kids' games, order whatever you want at a restaurant, that's the best feeling in the world.
But once you get past that point into ultra wealth, life actually gets worse.
It becomes a mess of logistical headaches. He talks about his friend with a yacht who's stressed out about a $30,000 air conditioning repair bill. It just adds complexity and stress.
And he says it often pushes people to dark places, chasing bigger and bigger dopamine hits because the normal challenges that give life meaning are gone.
Right. So his solution is to stay in that sweet spot personally and pour all the excess energy and capital into the foundation. The mission becomes growing the foundation, not just accumulating more personal stuff.
So let's bring all this back to you, the listener. What is the final urgent call to action on AI adoption?
The message is simple. Adoption is inevitable. Trying to resist it is like trying to resist email in 1998. You're just going to get left behind and become professionally obsolete.
So practical steps right now.
Spend 15 minutes a day just catching up on AI news. Follow someone who makes it simple, like the Mr. Rogers of AI. Just know what's going on.
And more importantly,
use the tools. Every single day. You have to get fluent with the top 15 or 20 AI tools for writing, for creating, for summarizing things in your job.
And the goal isn't just to be a little more productive.
No. The goal is to get so good that when you interview for a job, you can honestly tell them, you're hiring one person, but you're getting the output of 10 people. Because I know how to leverage these tools. That is the personal key to thriving in this new age.
Wow. This has been an incredibly detailed deep dive into not just the AI supercycle, but the mindset you need to navigate it. To recap the big themes, Long-term conviction, which has to be fueled by your own deep research, is the only way you're going to survive the short-term panic.
All those market dips, the DeepSeek scare, the Burry thesis, they are fundamentally noise, not a signal that the whole thing is broken.
And the high conviction plays are centered on the picks and shovels. Infrastructure, with Amazon leveraging its physical network with robotics. Power, with Bloom Energy capitalizing on the need for efficient DC power. And more importantly, speed.
And that generational wealth transfer, with Robinhood capturing the next wave of capital through its aggressive startup-like approach.
And remember, the biggest opportunity here is really societal. The promise of this supercycle is an age of abundance. Not just more stuff, but more time.
Allowing more people to live a life that's closer to that sweet spot of wealth, where you can engage with your family, do work you enjoy, and not be stuck in a job you hate for 60 hours a week just to get by. That's the 30-year mission we're really investing in.
So we'll leave you with this. We've talked a lot about how AI will make companies more productive. But think about this. If AI could truly make government vastly more productive and efficient, if it could eliminate the political fighting that's based on bad information, and ensure your tax dollars are spent to actually solve problems without waste, how much more willing would you be to engage with that system? How much more would you trust it?
This question of trust, really. And maybe, just maybe, AI could be the objective, non-human mediator we need to start rebuilding that trust across society. Until next time, keep digging deep.